What you do or don't do in the next few weeks will determine exactly how much you pay in taxes this year. So I'm going to walk you through the 5 tax moves that any business owner can make to cut their tax bill in half before the end of the year. The best part is just how simple these things are, yet they make a massive difference. So, what are those things? Number one, you want to be prepaying your business expenses ahead of time or before the end of the year. Number two, you want to be able to delay your income. Number three, an accountable plan, which we'll get into. Number four, making retirement contributions. And number five, a pass through entity election. You see, right now is the time that most business owners get complacent, but you actually have the opportunity to not only save thousands of dollars, if not tens of thousands of dollars, you also have the chance to set yourself up for success next year by making tactical moves to reduce your taxes. Now, if you want me to literally do all of this for you, we can only take on 2 more clients. So click the link in the description of this video below to apply if you want to work with us to save on your taxes. Now, without further ado, let me explain exactly how we managed to reduce some of our clients' taxes from before working with us, they were going to owe $50,000 to after working with us, owing only $15,000. Pretty good ROI if you ask me. And by the way, this is the exact same framework we've used for hundreds of clients. The truth is, being tax efficient is super simple if you just do what's right. Now, as we jump into today's video, I want to make sure that you guys kind of understand some of these. All of these strategies, they are simply a playbook, kind of like how Barney Stinson had the playbook. For those of you guys that are How I Met Your Mother fans, suit up, score chicks, and be awesome. Or the way I like to say is suit up, score tax savings, and be awesome. Now, one of the biggest things that I want to let you guys know is that this might sound very simple, but it actually is quite critical. You only pay taxes on the money that you actually receive and the money that you spend. And sometimes a lot of these strategies, they really are hiding in what is called plain sight. Now, this is again from a business tax return. And again, it's more I'm showing you guys where this says it in the IRS tax code because we're going to jump into what the cash method is in a little bit. But basically, it's what that is. It's when you receive money, when you spend money, that's how you are taxed. And again, this here is a business tax return. Again, I don't expect you guys to go up and look up the stuff. It's more so that you guys see it. This is 24, but the same logic applies for 25. Just the tax forms haven't been released yet, or at least as of the recording of this video. And again, this is straight from the IRS's rules. This is a tax return of what you pay taxes on. All of your business income. So basically, anytime somebody pays you money for services, you tally it up and you put it there, and then you get to deduct all of the expense you have, your rent, your taxes, your interest, depreciation, ads, all of that stuff. And then you get to what is your ordinary business income. And again, that's what you pay taxes on as a business owner. It's going to flow through a little bit differently for types of entities, but it's all the same. And again, right here, it's a math equation. You subtract line 21, all of your expenses from all of your income, and you pay tax on what's left over. Now, again, now that we understand that, I want to jump into what you actually need to do to save on your taxes, because it actually is quite simple. Now, the number one thing you want, or the first thing you want to do, is you want to prepay some business expenses. And when I say business expenses, I mean things that you are already going to incur. For example, your rent, your software, your insurance, things that you're already going to be paying, right? So, for example, my rent at this office that I have, it's due January 1st. But if I can pay that rent December 31st, I get that deduction, even though it's not due. So I can prepay some stuff. Now, again, if you're going to travel, if you know you're traveling in February, buy your tickets now. Don't wait until last minute. Buy them in December before the end of this year. Now, again, this is straight from the IRS's site, is that under the cash method, which we talked about, you can deduct your expenses in the year that you actually pay them, not when they're due. So you can prepay those expenses. And what that generally means is that you can only prepay them a year in advance. So, for example, I couldn't go to my landlord and say, you know what, I'm going to pay you rent for the next 15 years and get a deduction. I could pay it, I just couldn't deduct all of it. That's all that means. But as long as it's within a year, you can deduct it. Now, what I want you guys to do next is I want you to try to pay those expenses with a credit card. Our landlord here, Regis, they allow, shout out to them, maybe they'll get a sponsorship, is you can actually pay your expenses with a business card. Now, what I like about this is that I can swipe my card for my rent December 31st. However, that rent payment may not be due until February 1st or March 1st. So I swiped my card today, got a deduction, and it may not be due for maybe 30 to 90 days, depending on how fast your credit card turns over. That's one of the things when I say this is so simple, but yet so powerful. And I want to show you guys an example. Let's say we're looking at our P&L or our business statements, our financial statements, December 25th, and I'm like, shit, my profit is $100,000. But if I swipe my credit card and pay a few more expenses early that really I don't have to pay until February because that's when my credit card bill turns, well, now my profit is $90,000 and I haven't really spent a dime. So right there, just by prepaying some stuff, we've just lowered our taxes. Because again, you're taxed on your profit, or again, right here, you are taxed on what's left over. Your business income is the same as your profit. Now, let's go to step number 2, which is called delaying your income. So what I would have you guys do, and what I try to do, some of our clients don't always do this because maybe they're on recurring and it's a little bit more wonky, but it's the same idea, is that if you have recurring income, have your clients pay you in January or January 1. Because if they pay you December 31st, that's taxable at the end of the year. Now that tax is owed in April. But maybe if you have them pay you January 1, well, that falls into 2026 and you don't owe taxes until April of 2027. So by having somebody pay you 24 hours later, you've actually delayed that till the next year. So like I would just do that. An example, again, this is straight from the IRS's website or the instructions. Under the cash method, you include all the gross income that you actively or constructively received during the year. So again, that just means if you received it this year, you pay taxes. But if you receive it next year, who's to say? Now, again, you want to structure your contracts, and what that constructive means, it can't be that somebody paid you a check on April 1st of 2025 and you're like, well, I'm going to wait a year. One, the check might expire. But constructive means like you actually had it. You can't just like pretend you didn't have it. So again, just have them pay you January 1. Not a big deal. And again, I kind of want to show you guys a running tally here, right? Let's say that we found $10,000 of expenses that we can put on our credit card. Well, now if we just move some income to 2026, well, now our taxable income is now $75,000 and we've really just changed 2 things. Now that would save you a lot of money, but I'm not done yet. Now, number 3 is what's called an accountable plan, where you can reimburse yourself for your business expenses that you've paid personally. Now, we've all seen this form. We've all been employees at some way, shape, or form. We've all had to work for somebody. I did. When I used to have to travel for tax work or accounting work, I would drive and I would incur some miles and I would fill out a form just like this expense form and I would submit it to my employer. They would cut me a check and I would get back 50, 100, 200, whatever it was for my business expenses that I incurred personally. Well, you can actually do the same thing as a business owner because you are an employee of your business or you work for the business. So you can actually reimburse yourself for some personal expenses. And you guys might be wondering, well, you always tell me to separate stuff. Like, what if I don't have any? Au contraire, my friend, I actually think you do. Now, you actually have what is called your home office, your miles driven, your startup expenses. We all have that. For example, let's say that you have a home office. You can actually reimburse yourself if you own an S Corp for a portion of the rent or the mortgage that you pay, the property taxes. You can reimburse yourself. And let's say you forgot this whole year. You're like, man, I haven't reimbursed myself. Well, my friend, make sure you reimburse yourself before December 31st. And again, miles driven, startup expenses, things that you might have paid for. Let's say when you started your business in 2025 and maybe you bought some things personally, well, you can reimburse yourself. It doesn't really matter when, you can just do it by the end of the year. And again, this is more just for backup. If the IRS asked, how did you determine this? You fill out this expense report. That's all. And again, these are IRS guides that allows you to have accountable plans. This is straight from the IRS. And again, it's not so much you guys need to go look up publication 463 from 2024. It's that you guys see that this is where I'm pulling it from. This is all in the IRS's handbook. And again, if we just kind of look at that, again, we started with 100,000. We found some expenses to prepay. We delayed some income and then we reimbursed ourselves $5,000. Your taxable income just went from 100 to 70. And again, I know this is a simplified version, but you guys get the example. Anybody can do this. This is not some crazy hocus pocus magic. This is literally just following the IRS's code and doing it yourself. Now, number four is what are called retirement accounts. There are things like IRAs, SEPs, Roth IRAs, solo 401ks. It's not so much that you need to know which one to do, it's that you just want to know that you can do this. And again, you can contribute to this retirement account today in December, and you can take the money out tax deferred. Now, again, some people aren't wild about putting money away into a retirement account because they might think it's a scam or time value money. I understand that. I don't agree with it, but I understand where you're coming from. Now, one of the biggest tax strategies that people always talk about is buying a car. Go out and buy a G-Wagon, something over 6,000 pounds because you can deduct all of it. Yes, that is true. You can go out and buy tax deductions, but you might have a car that you don't want that's going to break down that you may not need. For me, I drive a 2024 Honda Civic, right? I buy that. I'm not stunting. I'm not a rapper. I just like good, efficient cars that don't cost me very much money or very much maintenance and are easy on my gas wallet because I'm not going to buy a depreciating asset. But some people will go out, put a down payment down and buy a heavy car, which I think is stupid. But if you don't need it, I would much rather you take $7,000 that you're going to put into an IRA, or sorry, $7,000 that you're going to use as a down payment, put it into an IRA or retirement account and have it appreciate. If you invest in the S&P 500 boring stocks, it will go up 8 to 12% a year. It will probably double 5 times by the time you take it out when you're 59. I'd rather have you do that than buy some dumbass G-Wagon that you don't need. That's probably going to fall apart on you because let's be real. And again, you can put away $7,000 into an IRA. Again, I'm just using an IRA as an example. You can do Solo K, Roth, SEPs, Simples, you know, all these things. It's more so that you guys can do this. And again, I'm pulling this straight from the IRS's site, meaning you could put away $7,000 this year, $8,000 if you're over 50. And again, all you really need is earned income. Anybody can do this. If you have a retirement account, you just have to have what's called earned income. And again, this is just straight from the IRS's site. If you receive taxable compensation throughout the year. And again, this is wages, salaries, self-employment income, alimony. Pretty much all of us watching this video have some form of income like this. You can put that money away and again, put it into a retirement account and I can guarantee you it will probably double, triple, quadruple, or maybe even quintuple over 20 years. This car will probably get trashed in 10 years and you don't need it. And be honest with you, nobody cares what kind of car you drive. As long as you're driving a Pinto or something, it doesn't really matter. Now, again, now that we have all of those expenses, again, we have $100,000 of income. Let's say we prepay some expenses, move some income just one day to January 1st. We find reimbursements and then we contribute to a retirement account. That is $63,000. Our income went from 100 to 63. That seems pretty good if you ask me. I would make that trade all day. And that's all from just making a few simple moves. Now, again, the last one that I like to talk about is a PTET or a pass-through entity tax election. Because I will tell you this, most people don't talk about it, all states are high taxed. Texas doesn't have income, but they have property tax and sales tax, and it is very high. So I will tell you this, all states do not have as many tax deductions as your federal tax deductions. You have to pay them because like the state of Iowa, we have what, 6 million people? Can't have that many people. They need all the money they can get. And again, let's just be honest, you're not going to get away from your state taxes. Every tax guru out there will tell you, you owe state taxes. There's almost no way around it. But again, a PTET election, you still have to pay them. You just pay them differently. Like this guy, you want to be smart. If you are going to pay these taxes, you can actually deduct them. It is what's called a pass-through entity election. And again, what this means is basically your business can pay your personal taxes, but get a business deduction. The reason why it happened in 2017, the Tax Cuts and Jobs Act, they made deducting state taxes more difficult by placing SALT limits. Again, it's not so much that you guys need to go look up your SALT limits and know them exactly. Just know that it is a little bit more difficult. This year it's a little easier, but it's more difficult than before. And again, this is the IRS notice that allows you guys to do it. I don't expect you guys to go read through this and comb through this. Trust me, I wouldn't do it either. But it's more so that it's right there in plain sight, and I'm not bullshitting you guys. So again, your business can pay your personal state taxes, and you get a deduction. So now again, let's have the tally up. If you have a $100,000 profit, and you prepay $10,000, $15,000, all this, your income went from $100,000 down to $61,000 pretty easily with just making very easy moves. This was very easy. Again, this was not something crazy or some cockamamie scheme. This was actually very, very simple. Now, again, if you guys want us to do this for you, and as you guys saw right there how we did this down. Now, this person's example, that was a very simple one. This example that I showed you guys at the beginning, how they went down from owing 50 to 15. Some of the stuff they did there, some of the stuff they didn't because of the way their business worked. But again, me just showing you a very simple a very simple set of instructions showed how you can get from 100 down to 61,000 pretty easily. And again, that was not crazy, crazy stuff. Most of the time, people talk about delaying buying rental properties and self-managing them and leasing cars and financing them. Nothing in there was about financing cars. How this person went from 100,000 down to 63. Now again, I realize some of the numbers might be bigger than others, but you guys get the idea. You can easily reduce your taxes or find an extra $10,000 to $15,000 in tax deductions just by doing things like that. Now, these are all very, very simple things that you can do on your taxes. These are not some cockamamie scheme. Anybody can do these. So again, I hope to see you guys on the next video. And if you want to work with us, make sure that you click the link in the description of this video. Work with us, apply to us, and we will hopefully lower your taxes, maybe not by $63,000, but at least find you an extra $10,000 to $20,000 in deductions that you didn't think you have. I will see you guys on the next video.